I think ultimately oil's been going higher because world demand has been going up at a time when inventories are tight. You're seeing the oil stocks go up with a lag. The MLPs, I think, are still recovering. Oil's going up more because of global growth than the issue with China. What we're still seeing with China today is this playground shoving match that has the chance to turn into an outright bench-clearing brawl where it impacts as much as $400 billion of the U.S. economy, especially U.S. manufacturers. That's where my real concern is on all this saber rattling with China.
David Spika, do you agree? I mean, how does this story continue to play out? Will markets continue to move higher despite the ongoing trade dispute as long as earnings growth stays strong?
Well, a phrase that is ringing through my head is, if it sounds too good to be true, it probably is. And that's what this environment feels like today. 4% GDP growth, 20% earnings growth, unemployment below 4%, wages not growing like they should. All of this is a Goldilocks scenario that is just not sustainable. And yes, that strong second quarter earnings is driving the market today, but I'm concerned that investors are extrapolating this current Goldilocks environment forward and expect it to continue. And we saw what happens when companies fail to meet earnings expectations with Twitter and Facebook and Netflix. Markets are not going to react favorably if these high expectations aren't met.
So what should I do, Mr. Spika?
I think you need to start de-risking. And again, can the market continue to go up from here? Probably. Will it? Yeah, there's a good chance it will. But at this point in the cycle, as late as we are, as much as we've made in the markets, particularly in technology, I think it's time to start de-risking. Tech has among the highest exposure to foreign sales of any other sector, and if the trade wars continue, that's going to have an impact on tech growth. Yep. So starting to de-risk, looking at lower beta asset classes makes sense.
I'm just struck with you saying de-risking. In golf, you know, when we're on the course, we never utter the S word shank, right?
Yeah, yeah.
Can you just not say the word sell, David Spika? Is that what a euphemism for de-risking?
No, that is not a euphemism for de-risking. I would never tell somebody to exit.
Yeah, you just transferring to lower risk assets. Or David Sowerby, are you willing to de-risk at this environment as we sit near all-time highs?
Very little on the margin, perhaps. But when we talk about a Goldilocks economy, we've still underestimated how much, not just the tax cuts, but more sensibility on regulation is renewed animal spirits. That's still got long legs left in it. If we were at Goldilocks levels, investor sentiment would be much more euphoric and robust. It is simply not. That's a good thing. That can allow asset prices to go higher. There's certainly risk in some of the priced for perfection, priced for sainthood stocks in technology. But when you take a look around in large cap and small cap, we're growing dividends better than 10%. We're growing free cash flow quite healthy. I'm still finding great valuations in small caps like Designer Shoe Warehouse, Kearney Financial, where there's abundant free cash flow and they're buying back 10% of their shares outstanding. I don't think that's a overpriced, over-excessive market that you want to be significantly de-risking.